The topic under discussion is money. Moving on to what is money. Now, money is accepted medium of exchange for all goods and services used in all economic transactions worldwide. Initially, it stood for anything which was accepted by people as form of money. For example, even iron, copper, corn, salt, horses, paper, rice, etc. All these were accepted as money to make transactions. Now, what are the functions of money? In today's times, we have money which serves as a medium of exchange. It is a store of value, that is, it allows individual households to hold value and take it to the future. Then, it is also helpful in settling deferred payments, that is, debts which are maturing in future. Further on, it is obviously the most liquid of all assets. If we go through the liquidity spectrum of various financial instruments and see moving from left to right in terms of increasing liquidity, we see that antiques are the least liquid of all assets, whereas cash or money in hand is the most liquid of all assets. Now, money demand by households actually rests on these two fundamental questions, that is, how much or how many financial assets is one willing to hold in form of cash or money, that is, on which no interest can be earned, versus how many financial assets is one willing to hold in form of interest earning securities or bonds. Before we actually move on to see how households decide, we have to go through 5 basic assumptions. First, there are 2 kinds of assets which are available to households. One is bonds and money. Now, income comes only once a month, but expenditure or spending occurs uniformly throughout the month. Now, this spending is definitely in proportion to the monthly income, but there is always an apparent non-synchronization of income and demand, that is, there's a mismatch between timing of money inflow to household and money outflow for various expenditures. Now, household motives which decide how much money to keep in what kind of assets. The first one is the transaction motive or the transactions demand. Now, transaction is the primary reason for people to hold money because they are able to buy the goods and services of their choice. Second comes the speculative motive or the asset demand. Now this thing is for making profits, as market value of interest bearing bonds is inversely proportional to interest rates. Now this means that investors hold bonds when interest rates are high with the hope of selling them when interest rates fall. Thus, it can be said, when interest rates are high and expected to fall, demand for bonds is likely to be high and demand for money is likely to be low, and vice versa. Finally, we have the precautionary motive, that is, holding money to meet unplanned expenditures like emergencies. Now, its level also varies with the interest rates, because where demand for transactions is fixed depending upon income level and some fixed expenditures, precautionary and asset demand are based on opportunity cost for holding money. Now, this opportunity cost will in turn depend on the prevailing interest rates. Now, let's see how money is actually defined in our economy. So first we have the M0. Now, it forms a basis for broad money. It is known as monetary base and is closely related to consumption changes. Further, it includes currency with the public, bankers' deposits with RBI, and other deposits with RBI. Moving on to M1. M1 is also known as the narrow money and is the leading indicator of any fluctuations in the economic cycle. Now, also, it is the most liquid measure of money supply, as money included in it can be easily used as a medium of exchange in various transactions. M1 comprises of the currency with the public, demand deposits of public with commercial banks, demand liabilities portion of saving deposits, and other deposits with RBI, excluding deposits with International Monetary Fund or Provident Fund, etc. Coming to M2. Now, M2 is the broad money and is an indicator of the money supply for the future. It stands for M1 plus post office saving deposits, or in going in details, currency with the public, currency deposits with banking system, saving deposits with banking system, certificates of deposits issued by banks, term deposits of residents with a contractual maturity up to 1 year, and other deposits with banks. So, but reason why money supply or M2 has been put in different slot than M1 is that saving deposits with post offices are not as liquid as demand deposits with commercial banks, as the former are not checkable accounts. Going to M3, it is the broad money. It's known as the broad money. It stands for M1 plus term deposits with banks, and it is the primary focus or the prime focus of the monetary policy nowadays. Now, contrary to the common belief that term deposits are not as liquid as they cannot be withdrawn by checks, loan from banks can actually be obtained against these. Also, these can be withdrawn at any time by foregoing some interest which is to be earned on them in future. Moving on to M4, it stands for M3 plus total deposits with post office savings organizations, and this excludes public contributions to national saving certificates, etc. Now this is very interesting, how banks create money. Now banks create money by a very interesting system called fractional reserve banking. Fractional reserve banking is a system in which depository institutions hold reserves less than the amount of deposits or less than the amount of actual deposits. However, banks do have to maintain compulsory reserves with RBI, and the percentage of the same is also decided by the central bank or RBI in Indian case. Secondly, banks create money with the help of money multiplier. Now this actually is the multiple by which deposits can increase for every dollar increase in reserves. Now this is 1 by the required reserve ratio, which is the cash reserve ratio in case of India. Finally, now banks make loans to the maximum amount possible, that is after satisfying the restrictions of reserve requirement, that is till the moment the excess reserves are zero. Now excess reserves is nothing but bank's actual reserves and its required reserves. With thus we come to an end. Thank you.